Joining us now to discuss is former FDIC Chief Innovation Officer Sultan Meghji. He's currently Duke University professor and scholar at the Carnegie Endowment for International Peace. Sultan, so you were with us just 3 weeks ago when U.S. banking regulators warned banks about crypto liquidity risks. And at the time, you said it was a big nothing burger in the sense that they've sent many vague warnings. But what do you think has changed between then and now?
Well, a couple of things have happened. First, the actual impacts of the Fed rate interest rate hikes have finally come home to roost. And in a couple of these banks, they clearly had balance sheet issues and were clearly struggling with other issues that were under the surface, which is rather surprising considering that that's kind of the job of some of these agencies is to find that in their examination process. I think the more interesting thing is this ability that the FDIC in particular has taken to use this to, in essence, push out some of the more innovative banking players. And it certainly does seem like there was whether unintended or not, they're using this as a ability to declare victory over getting crypto out of the banking system.
So state regulators are looking to sell Signature Bank after taking over Sunday. And the latest from Reuters is that buyers have to agree to give up all crypto business at the bank. How does a policy like this exist at the FDIC? How usual is this?
It's actually not that unusual. The FDIC has incredibly broad authorities that, come out of statutes going back nearly 100 years. And it really comes down to what the chair of the FDIC and the FDIC's board want to do. The gap between what's written into law that's passed by Congress and what the agencies do, what the agencies are not allowed to do is incredibly broad. So if you put a leadership team in there that says we want to remove, the color purple from the banking system, they basically can. And there's not a whole lot that Congress or the rest of the executive branch can do without, passing a law. And so, the line actually in the statute says the FDIC has the authority to regulate money and its equivalencies in the American financial system. I mean, that's an incredibly broad set of language. You can look it up. It's kind of hilarious. And so they get to do that. And as such, they get to purge anything they don't like. Wow.
Well, that is entirely incredible. And it has a lot of people in the crypto industry stunned because these are legal businesses. In fact, Congressman Tom Emmer has been tweeting a letter to the FDIC chair, Martin Grunberg, regarding reports that the FDIC is weaponizing recent instability in the banking sector to purge legal crypto activity from the U.S. So Barney Frank, who also serves on the board of Signature, was saying that, that bank had funds. They were ready for withdrawals by Monday over the weekend. He thinks Signature was shut down for crypto-related reasons. And the FDFS is saying, nevertheless, that it was a crisis of confidence in bank leaders. Where do you divide the difference?
I mean, this is one of the great things about the FDIC. They can really say whatever they want in this regard. The balance sheet of Signature Bank, it was fine. There was really nothing there. And I've heard the same stories you have, that there was some sort of crisis. I don't think anybody who was there saw an issue with that. And certainly Signature Bank was fully operating almost immediately afterwards. I know a number of organizations that banked with them and still do, and they were kind of doing everything normally. So it does seem that the Signature was a little bit different than Silicon Valley Bank, for example, which did have a balance sheet concern.
All right. And now we're hearing about Credit Suisse having problems. The Wall Street Journal is now reporting that First Republic Bank is talking to major U.S. lenders about a lifeline and various options. So it appears that this has gone certainly beyond crypto. They can't blame the crypto industries for this, and it's gone over to the wider banking sector.
That's absolutely right. And I mean, Credit Suisse has been a problem child in the banking sector for a long time. They've always kind of had some challenges, and they've had some, warts on their balance sheet for a while. So it's not surprising that in an environment where there's pressure on banks, based on, health of their balance sheet, the Credit Suisse is on the wrong side of that. First Republic is a little different, I think, especially because, over the last week now, it looks like between the $70 billion they got from the Federal Reserve and JP Morgan, and now a potential 20 or 30 additional billion from the other banks, it is fairly clear that First Republic probably has some other balance sheet issues. I personally wouldn't be at all surprised if First Republic didn't get bought by, one of the larger banks. I think it's been reported that both JP Morgan and Morgan Stanley are looking to acquire it, which makes a lot of sense for that institution. But, if you break this out, the actual banks with balance sheet issues have almost nothing to do with crypto in terms of it being an impact on their balance sheet. It's mortgage-backed securities, it's bonds, it's Fed interest rate impact on the balance sheet, it's, venture debt in the case of Silicon Valley Bank, which had about 40% of the venture debt market in the US. I didn't say crypto in any of those things. So it is sort of a interesting thing that there's a crypto part to this discussion.
So why do you think that is crypto being politicized? Why do you think that they're going after crypto?
Well, crypto has been politicized for a long time, and I think it's kind of fascinating to me because the American financial sector is older and a little more analog than so much of the rest of the world, and the technologies underlying cryptocurrencies, whether it's the more modern Web3 technologies or just traditional distributed ledgers, or some of this new stuff like zero-knowledge proofs, are all fundamentally better technologies than the mainframes that are running most of the banks in the United States. And this is a significant challenge for us as a nation. The farther we get out, where there are more countries and more companies around the world doing very interesting modern digital activities, especially payments, identity, cybersecurity. These are all issues that we need to get in front of. And by closing off the American banking sector to a lot of these new modern technologies, we're, I think, fundamentally hurting our country, and not just our ability to lead in this space, but also our overall macroeconomic leadership. And that goes all the way down to being the primary reserve currency for the world.
Meanwhile, what do you make of the FDIC withdrawing and then returning $40 billion in the funds from the Treasury General account? What's that all about?
That's, wow. That doesn't look good, does it? I mean, it certainly implies that someone somewhere didn't do the maths correctly, and that's not a great thing to see from either of those institutions.
Does it put into question confidence in what the Fed has in store? They've got rate hikes next week. They created a bubble, some analysts say, and now they're trying to pop it. Now they don't know what to do.
Yeah, I mean, there are a lot of conflicting sets of data going on right now, and I don't think the Fed or anyone else really understands what's going on here. We've never been in a situation where we've had this much rate hike happening in such a short amount of time, with such a hot job market, with an inflationary pressure all at the same time. And that's just one piece of this discussion. I think one of the things that people have maybe lost the conversation on that's also going on is the debt ceiling, right? I don't worry about waking up tomorrow and my checking account being zeroed out and not being able to get that money if my bank fails, because I trust the full faith and credit of the United States to protect that under FDIC insurance and now this new, more expanded program. The thing I do worry about is if we don't solve the debt ceiling debate in Congress and all of a sudden the U.S. defaults on its loans, and that becomes a significant issue. If the U.S. dollar goes down, or if the credit rating in the United States goes down, that's a significant issue, and I worry about that. And these are all, to a degree, distractions relative to that.
Yeah, that would be a larger issue than what we're seeing here. But I am curious about your thoughts on this Operation Choke Point 2.0 theory out there that federal financial regulators are trying to get rid of crypto company access to the banking system here in the United States.
Well, whether or not they designed this program, and it's kind of hard to disagree with some of the thinking out there because it's a lot of the same people back in charge of some of the same agencies, it's hard not to see that that's the impact of what they're having. And so we're seeing, billions and billions of dollars leave the American banking system and go elsewhere. And sadly, they're going to places where, at the end of the day, it's going to be a bigger challenge for us. So whether or not the design of this entire set of programs was in the vein of a choke point 2 type activity, that's certainly the effect. And that's the thing that matters.
All right, Sultan, thank you for joining us. That was former FDIC Chief Innovation Officer Sultan Meghji.